If your goal is to generate quote-unquote passive income, then one of the most accessible ways to do that is by investing your money into dividend-paying stocks. But most people are investing in dividend stocks the wrong way. When most people think about investing in dividends, they're looking for a company that's paying out the highest dividend because the highest dividend means the biggest paycheck that you're going to get without having to do any work. And that makes sense in theory, but it doesn't always work out the way that you expect. Let me show you what I mean. The AT&T company has been known as one of the best dividend-paying stocks for a number of years. But even if they're paying out strong dividends like they're doing at the time of recording this video, if the stock chart looks like this, that can make you nervous as an investor. Now, I'm not saying if AT&T is a good stock or a bad stock. What I'm saying is if your goal is to be a dividend investor, there are some tricks that you can use to find good investments that will allow you to generate cash flow without having to consistently keep monitoring your investments, because the goal isn't just to generate cash flow, it's to own a good asset that's hopefully growing in value, that's also growing in the cash flow that you're generating. So if your goal is to supplement or completely replace your job income with your dividend income, let me go over a couple tricks that you can use to lower some of your potential risk as an investor. That way you can continue to get steady and healthy cash flow from your investments. Now, of course, investing has risks. You're never guaranteed to make money when you invest. In fact, you will probably lose money at some point. So make sure you always do your own due diligence and never blindly trust a random guy on YouTube. And of course, all the stocks and funds that I discussed today are just as examples. They are not recommendations. Strategy number one is to look at a company's dividend history. Now, while this cannot perfectly guarantee what's going to happen in the future, it can give you some sort of idea of what a company's done in the past. Let me show you. In the dividend game, you have different categories or classes of dividend-paying companies. For example, you have dividend achievers, dividend champions, and dividend kings. And all these do is kind of just categorize stocks based off of how long they've been paying out dividends and for how long they've been increasing their dividends over the past. So, for example, a company becomes a dividend achiever if they have paid out and increased their dividend every year for at least the last 10 years. A company becomes a dividend champion if they have paid out and increased their dividend every year for at least the last 25 years. And a company becomes a dividend king if they have paid out and increased their dividend every year over the last 50 years. Now, you can see that it becomes a little bit more difficult as you go down this list, but now you can start to do your research by looking at companies that have been paying out and increasing their dividends year after year after year. Now, you might be wondering, but Jaspreet, how do I go out and find a dividend achiever or a dividend king? How do I actually do this research? Well, thankfully, there's this amazing research tool that is actually free called Google. And you can just go to Google and search dividend achievers, and you will see a list of dividend achievers in the stock market. Or you could search for dividend champions, and you'll see a list of dividend achievers in the stock market. Or you can search dividend kings, and you will see a list of dividend kings in the stock market. Now, again, you don't want to just blindly throw your money into a company because they've been paying out and increasing a dividend. That's just the first part of your research. But this can give you a little bit of a guideline of if you are looking for a company that has been paying out and increasing their dividends because you want future growth in your dividends, this could be at least some sort of basic starting point for you, because if a company has been paying out and increasing their dividends, that could potentially mean that they are a strong company and they are focused on providing steady and strong cash flow to their investors. Will this guarantee you make a good investment? Absolutely not. But at least it gives you a starting point. The second strategy that you can consider is not investing into a dividend-paying company, but rather invest into a dividend-paying fund. Because if you are not interested in this whole game of trying to keep up with a company, researching a company, studying their earnings, and making sure that this company is still a strong company, because sometimes companies do fail, sometimes companies go bankrupt, and if you keep investing your money into a fund for a number of decades trying to build this cash flow and then they go bankrupt, not only do you lose their cash flow, but you lose all the money that you invested. But there is a way to mitigate some of that risk by now investing your money into a dividend-paying fund. Now you can invest your money into a fund that's paying you a dividend, and this fund could be made up of dozens or hundreds of companies. That way, if one of the companies in the fund goes bankrupt, well, it's balanced out by the other winners. So it's a way for you to reduce some of your risk, and now you can also mitigate some of your time, because you can set up a system where not every week or every 2 weeks or every month, you're just putting a little bit of money into this fund, and now you don't have to keep up with the fund the way that you would if you were investing your money into an individual company, because investing your money into individual companies comes with more risk, it comes with more time, and you need a little bit more experience if you really want to make money and analyze your investments as opposed to just putting your money into a fund. So let me give an example of what this looks like. So PFM, again, I'm not telling you what to invest in, just giving you some examples. PFM is an ETF that gives you exposure to dividend aristocrats. Now, if you remember what I said just a minute ago, dividend aristocrats are companies that have paid out and increased their dividends for at least the last 10 years. So now you could look at the list of dividend aristocrats and find some companies that you want to invest in, or you can just invest in dividend aristocrats by investing into this fund like PFM, and now you're getting exposure to dividend aristocrats and you don't have to put in the work to try to find the best company. Now, at the time I'm recording this video, the PFM ETF invests into about 400 companies. SPYD is an ETF that gives you exposure to dividend-paying companies in the S&P 500. The S&P is a group of the 500 largest companies in the stock market. Now, out of this group of the 500 largest companies in the stock market, not every single one of them pays a dividend. Maybe you just want to invest in the companies that are paying a dividend, that way you can start generating some cash flow. Well, SPYD makes that easier for you because this is a fund that invests in companies in the S&P 500 that are paying out a dividend. At the time of recording this video, SPYD invests into 80 different companies. And then you have VYM, which I should put a little bit of an asterisk here because as a disclaimer, I do personally have some of my own money into VYM. This is an ETF created by Vanguard, which invests in dividend-paying companies on the stock market inside of the United States. So it's a little bit broader than this and this, but at the time of recording this video, this has 462 companies in this fund. So now, if your goal is to generate cash flow and you want to build long-term cash flow, which means that now you're going to be consistently investing your money into these dividend-paying stocks, you can either invest your money into individual companies or you can invest your money into a fund. If you put your money into a company, well, now you run the risk of that company going bankrupt or something bad happening to the company or your stock price going down. But if you put your money into a fund, and there are many, 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 many other funds. This is just an example. There are many different funds out there depending on what it is that you want to invest in, what type of exposure that you want. Well, now you don't have that same level of risk. Is there still risk? Yes, but you're mitigating some of the risk because now you're investing in multiple companies. This is where now, if you really want to succeed as an investor, you want to dig a little bit deeper into the whole idea of dividends and why companies pay dividends. And before we jump into that, I do want to let you know that if you are interested in learning more about investing, my team at Briefs Media created this amazing ebook on how to build wealth as an investor that walks you through the basics of first, how do you build the mindset of an investor, to getting into more of the complex and advanced stuff of different investing strategies. How do you generate cash flow? What are different cash flow ideas? How do you protect your assets? How do you spend your money smartly? This ebook is completely free. So if you want a breakdown of how to build wealth as an investor, this is a free guide that can help you with that. So if you want to read this ebook for free, I got the link to how you can download this ebook down in the description below. Now, to understand how dividends really work, let's assume that a company makes $1 billion in revenue by selling their stuff. But this isn't all just profit. They have to have expenses. Like you got to pay for your employees, you got to pay for your rent, you got to pay for your machinery costs and everything in between. And if now the cost of running this business is, let's just say $500 million, that means this company at the end of the year will have $500 million in profit. This is cash that's sitting in their bank account at the end of the year. Now, when the company, the stock, has this $500 million sitting in their bank account at the end of the year, there's three things that they could potentially do with this cash. Option number one is they save this cash for emergencies. Maybe they want to build in a rainy day fund because we remember when the pandemic happened, companies ran out of money very quickly. So one thing that a company could do is potentially save some of this money. Option number two is they can invest some of this money back into the company. Because now let's say this company wants to open new stores. It wants to open new manufacturing facilities. It wants to invest in research and development. It wants to open a new operation in Asia. Well, in order to do that, you need money. And if a company is trying to grow very quickly, they're going to be very heavily investing this money back into the company. That's why you don't see a lot of startups paying out dividends. It's because they don't actually have any profit. They're investing all this money back into the company and some because they're going out and getting debt. They're trying to find more investors. That way they can grow as big as possible, as fast as possible. But then you have option number three, which is a company can give this money away. Now, there's a couple different ways that a company can give this money away. I'm not talking about giving it away to charity. I'm talking about giving it away to the shareholders, the people that own the stock. Now, the first way that this company can give this money away is by buying back some of their own stock. So if you have $500 million worth of profit, they can now go out and buy $500 million worth of their stock. And what does that do? Well, that helps inflate the stock price. Because if there's more buyers than sellers of the stock, well, then that pushes the stock price up. And the reason why some investors like that is because you don't actually see any cash in your pocket. Because if you just see the stock price of your investment go up, well, you don't have any taxable event because you only pay taxes when you sell or if you get some cash in your pocket. So if the company buys back their own stock, some investors prefer that because it's a way for you to make more money on paper because now your stock price is higher. However, the flip side of that is there's a chance that you don't actually see any of that money because then the stock price could go back down, anything could happen, and you don't actually see that money because you don't actually make any money until you sell your stock. So that's where the alternative is they can give it away in the form of a dividend. Now, when a company pays out a dividend, it's literally just a cash payment. It means the company is distributing checks, which nowadays are not checks. They deposit it directly into your brokerage account. The company is just distributing this money right into your account, and you don't have to do anything to really earn that money except own that stock or own that fund. And the nice thing about this is you can get paid without having to do any work because if you own a stock, you own a company that's paying out a dividend, all you have to do is own the company and now you're getting paid. But there are some cons with that because now you have a taxable event. When you get a dividend, you have to pay taxes on this money. Now you might think, but what if I take this money that I get from my dividend and I reinvest it back into the company or I reinvest it back into the fund, which is actually a really good strategy when it comes to building wealth, especially as a cash flow investor, because now not only are you contributing more money to buy more of this cash flow, but you're using your cash flow to buy more cash flow. It's a great opportunity and it's a great way for you to increase how much cash flow or passive income that some people like to call passive income. I prefer calling it cash flow because passive income can kind of have a more of a deceptive title to it. But now, if you're generating this cash flow and you're reinvesting it, the goal is to generate more cash flow. However, even if you reinvest your dividends, you still have to pay taxes on that income, even if you never see it. So yeah, there is some downfalls to investing for dividends because you got to pay taxes, but at least you get that cash in your pocket today and you don't have to actually sell your stock to get any of the money. Personally, I like cash flow investing. For me, I like the security of having cash flow because for me, the game is to stack cash flow. Whether it's from stocks, whether it's from real estate, I want to stack the cash flow because now I know that this cash flow is going to keep coming in, and then my goal is to be able to live off of the cash flow because if I can use my cash flow to fund my entire lifestyle, well, now I'm financially free. I can do whatever I want, and I can just keep living off of the cash flow. I can spend my money in whatever dumb way that I want, and I know I'm going to get another cash flow check next month or next quarter. Most companies and most funds that are paying out a dividend are paying out their dividends or their cash flow payments every quarter, meaning every 3 months. Now, the reason why it's really important for you to understand when you're investing for dividends, you're not just investing for the cash flow, you're investing in the underlying asset, is because sometimes that dividend that you're getting can be deceptive. Let me show you what I mean. Let's assume that you want to go out and invest in this XYZ company. I'm not saying this is an actual company, just an example. And at the time, this is trading for $100 a share, and it's paying out a $5 dividend, which means it's paying out a 5% dividend yield. Not bad. But then something bad starts to happen in the company. They start to put out a bad product, people stop liking the company, and then the stock price falls to, let's just say, $50 a share. Now, if they haven't adjusted their dividend yet, that means this company's trading for $50 a share, their dividend is $5, which means now they're not paying out a 5% dividend, they're paying out a 10% dividend. Now, at face value, this looks like a much more attractive investment because take a look, you're getting a 10% dividend as opposed to a 5% dividend. But it's not showing you the whole picture because if you look at the whole picture, what you see is, yeah, you're getting a 10% dividend, but the stock price has fallen by 50%. So maybe there's something majorly wrong with the company. If you feel like this is a great opportunity to come in and buy this company because they're going to turn it around and you're going to see the stock price soar, then sure, it could potentially be a good investment. Of course, it has risks, but what you want to understand is you are not just buying the cash flow, you are buying the company. And that's why it's so important that when you're doing your dividend analysis, you look beyond just the percentage that you're getting, you look beyond just the dollar amount that you're getting, you look beyond just the share price, you're looking at what the company is and how strong the company is. And that's what should be deciding your investment decisions because you want to invest in the company, not just in the cash flow, because the cash flow number or percentage that you're seeing can be deceiving if you're just looking at that by itself, which is why that is just one piece of your investment decision. You want to look at the actual investment. That way you can make a smart decision for yourself. Now, when it comes to coming up with a strategy for how do you actually invest your money into cash flow producing assets or into stocks that are paying out dividends, one thing that I like to do, you're going to come up with the best strategy for you, is I have funds that I invest in for cash cash flow. I have ETFs that I invest in for cash flow. And for me, what I do is every Wednesday, cash is pulled out of my checking account and is automatically invested into my portfolio of ETFs. This happens automatically, this happens passively, and it happens consistently, no matter what, whether the market's up, whether the market's down. This is going to happen because I just want to keep stacking the cash flow. Now, as I get my dividends, I just reinvest my dividends because I don't need my dividends right now. But that's the game that I'm doing. That money is automatically being invested for me, and now I'm just constantly working to buy more cash flow. Every week, I own more cash flow producing ETFs. And now when my cash flow producing ETFs pay me with dividends, I use those to buy more cash flow producing ETFs. So it's become a machine where now I'm working to generate some income. My income is being used to buy some dividend paying ETFs, and then my dividend paying ETFs are buying me more dividend paying ETFs. But of course, you got to find the right strategy for you. But if you want to use your dividends to replace or supplement your income, you got to get started. You got to figure out what it is that you want to invest in, and then you got to come up with a strategy for you.
US News put out this article on what they call the 7 best dividend-paying ETFs that you can consider buying. Here are the 7 ETFs that they recommend, and again, investing has risks. Make sure you always do your own due diligence and never blindly follow a random guy on YouTube. Number 1, SCHD, which is paying out 3.6% a year in dividends. VY